I think really the open outbreak of World War III. That's my biggest concern because there are eruptions in all these different pockets in the world. And that is something that occurs and it justifies the inflation. It justifies a lot of loss of freedoms. It justifies a lot of things. And so it's really the geopolitical hotbed that we're moving into. Well, if you look at the CME contracts, what you'll find is in the last quarter of this year, there's like a huge spike into it. So the volatility is caused by the traders and also by the CME group. What did they do? Although this is not new for 2025, but as more and more interest in those silver contracts, we're not talking physical, we're talking about contracts. As those contracts as traders have been piling into the contracts, they've been raising the margin requirement, which actually just started yesterday as well. So, or on Monday, is when those contracts went into effect, meaning that traders have to carry a lot more collateral on their books to execute these paper contract trades. So that, of course, there was a lot of profit taking on Monday's market because that's also when those margin calls went into effect. So, or the new margin, I should say, went into effect. So yeah, I mean, it's easy to manipulate it when it's a paper market, but the reality is we are also transitioning into the physical market giving you good price discovery, which we're not there yet, right? But that transition started last January. So we're like almost a year old into that transition. So yeah, there's lots going on.
Precious metals markets don't operate on fairness. They operate on policy and leverage. When prices rise too quickly, margin requirements can be raised to cool speculation. When authorities want more risk-taking, leverage is loosened. This is no different from central banks adjusting interest rates to stimulate or slow markets. Today, expectations of easier monetary policy are already fueling optimism across equities. But this isn't free market capitalism, it's late-stage financial engineering. Historically, such behavior appears near the end of currency cycles, when markets become dominated by speculation rather than true price discovery or productive growth.
You know, Ivan, I like you so much. But fairness is not really something that goes into these markets.
Right.
If the markets were fair, then you would see gold somewhere around $40,000 an ounce and silver likely around $2,000 an ounce. So this is about trading. And yes, there are no limitations to what they can do as far as if they want to boost that, well, then they can lower the margin requirements and encourage more leverage and debt. If they want to stop a price rise, they can raise the margin requirements to do so like we've just seen. And no, there are no limitations, just like the central banks lower interest rates to inspire more of this stuff.
Right.
And the markets go, woohoo. I mean, on Wall Street, every single stock analyst, every single one is anticipating a huge stock rally into 2026. Why? Because they expect the Fed to lower the rates and do a lot more of this.
Right.
We already just recently saw the Fed pivot, turning around to buy the debt of the government, which we may have talked about because this was anticipated. Of course they will. Right? So, but none of this is about fairness. None of this is even really about real capitalism. It's really just about a trading market, a gamble, which is typical at the end of every single currency's life cycle. Very typical.
While paper markets can move instantly, physical markets change slowly. That transition from paper-driven pricing to physical supply and demand began gaining momentum over the past year. Large volumes of metal have shifted location globally, signaling growing demand for real ownership. Paper contracts can be created endlessly, but physical gold and silver cannot. That distinction is becoming increasingly important. Price discovery still happens on exchanges, but the influence of physical shortages is growing. Over time, this creates pressure that paper mechanisms struggle to suppress, especially when confidence in financial systems begins to erode.
Well, I would say number one, don't worry about the contracts because they're not real. Go into the physical markets and hold it yourself.
Yeah.
That would probably be the single biggest thing because the paper markets can whipsaw like that, but the physical markets don't whipsaw like that. That requires time in the physical world. So we know that if you don't hold it legally, you don't own it, and this is the time to be at absolute safety. Do I think that with the Fed pivot and more money printing, the markets will go up? Yeah, because we are in the melt up phase. But this looks an awful lot like 99 did. And keep in mind the derivative explosion that happened in 98 with long-term capital management that nobody really seems to know about because it was covered up so beautifully and quietly. But, you know, I think we could see another derivative event in 2026 easily. And don't be fooled by the hype. You want to understand what's really happening. And that really is what they've been talking about openly for the last, 6-8 months, is the devaluation trade, which really is just lots more money printing, pulling the purchasing power value out of the currencies. That's what you need to protect yourself from. So you can only really do that in the physical markets.
Owning physical metal removes counterparty risk. If you don't hold it, you don't truly own it. Paper instruments can fluctuate wildly, but physical metals move at the pace of mining, refining, and delivery. This makes them far more stable as long-term protection. Diversification within physical silver matters too. Coins, small bars, and even sterling silver all offer flexibility. Smaller denominations are easier to trade and use if liquidity becomes important. Large bars may look impressive, but practicality favors portability and divisibility, especially in uncertain economic environments.
Well, personally, I like silver in any form. So yes, definitely coin form is a great way to do it, but you want a variety of sizes, right? So this is pre-1965 constitutional silver. It's roughly 1/10 of an ounce. These are 90% silver. This is a new silver eagle, and that's 99.9% pure. And I even like it in this form.
Oh, nice.
Sterling silver. So if it's marked sterling or it's marked 925, then it's 92.5% pure. So I really like it in any form. I'm not super keen on large bars because they're too hard to deal with. So my preference, if you want to do bars, that's fine, but do it in smaller, ounce or lower. Other than that, I'd say do it in coins. It's just a better way to go. I think really the open outbreak of World War III, that's my biggest concern because there are eruptions in all these different pockets in the world. And that is something that occurs and it justifies the inflation. It justifies a lot of loss of freedoms. It justifies a lot of things. And so it's really the geopolitical hotbed that we're moving into that has me the most concerned, and what that will do to inflation and the bond market, which has already popped. That popped in 2022. They've just been like reinflating it by pumping more money into the system. But the biggest concern is probably geopolitics.
The greatest risks ahead may not be financial, but geopolitical. Global tensions raise inflation, disrupt supply chains, and justify aggressive monetary responses. At the same time, silver demand is accelerating due to industrial use, especially in energy infrastructure, electronics, and artificial intelligence. Unlike gold, silver is consumed in manufacturing and often unrecoverable. That makes its supply fundamentally different. As industrial demand rises and inventories shrink, silver's strategic importance grows. These pressures are not theoretical. They are already reshaping how markets value tangible resources versus financial claims.
Really, I think the biggest thing, and I don't think that most people realize it, is the breakdown that's really happening on Wall Street in terms of the contracts versus the physical markets. And I would say, especially with gold and silver, gold is the primary currency metal. Silver's the secondary currency metal. Silver and copper are used quite a lot in AI and all of the build outs of all of these energy generating units for
Right.
AI. So, but you need the physical, because even though you're going to see some level of reflection in the paper market, you don't actually own the underlying. Now, that's not entirely true. You can buy a futures contract and you can take possession of, 500 ounces of gold or down to an ounce of gold. In theory, you can take possession. But in reality, there is a shortage in the physical markets, particularly in silver, because that gets used up in manufacturing. Gold is indestructible, but silver is not. And so that's a big reason why we're seeing silver's outperformance. However, having said that, even when it broached that $80 an ounce, which to some people just seems incredible,
Yeah.
I am going to suggest to you it is not even marginally close to the true fundamental value of an ounce of silver. So hold it, own it, protect yourself, and just allow whatever. You can't stop what's going to happen.
Right.
You can get into a position to take advantage of it. And that's really what gold and silver do. Well, I'm with you. I don't really like price predictions.
Yeah.
This is a paper trading market.
Right.
Said that, and understanding the true fundamental value of an ounce of gold and an ounce of silver. But I would think that by the end of 2026, especially if World War III is kind of announced and people get that, it
Right.
would not surprise me at all by the end of the year to see spot gold somewhere in the vicinity of even $6,000 an ounce. That wouldn't surprise me. And it wouldn't surprise me to see spot silver at around $200 an ounce. You might want to write those numbers down, and we'll see how close I get.
Price predictions are unreliable in paper-driven markets, but understanding value is essential. Even at elevated prices, silver remains far below what many consider its true fundamental worth. Gold and silver aren't tools to stop systemic change. They're tools to endure it. History shows that during periods of monetary debasement and geopolitical stress, real assets preserve purchasing power while currencies lose it. Holding physical metals is not about speculation, it's about positioning. You can't control the direction of global events, but you can choose how exposed you are when the system adjusts.